Now, let's ask Rob Thummel, portfolio manager at Tortoise Capital Advisors. Rob, it's good to see you. Are you scratching your head like everybody else here, or is it simply a recession and Fed story?
I think what's happening is we're just simply having the risk-off switch, or the risk switch has been turned off effectively here with this uncertainty in the banks, and that's just caused a lot of sectors, including energy, to trade off, and that's been led by obviously a pretty sharp decline in commodity prices, as you highlighted, really over the last year, and then obviously over the last week as well.
So what it's shown us is that the supply-demand dynamic can't overcome monetary tightening. Is that right?
Yeah. So if you look at the fundamentals, the operational fundamentals in the energy sector in particular, really are quite strong. The forecasts for 2023 to have record levels of crude oil demand globally. You know, the U.S. is going to produce a record level of natural gas. The U.S. is going to export a record level of LNG. So the U.S. has really solidified itself from an energy perspective as a provider of reliable, affordable energy, not only domestically, but also to the rest of the world. And that'll be a positive for the energy sector throughout the year.
When we talked in December, and all of us, everybody in the energy market, thought that the China reopening was going to be a huge source of marginal demand. Why hasn't it been? What happened? And Pippa Stevens has highlighted this, that it's not our imagination when she tracks those ships, those tankers that might be bringing crude to China. Those levels are down. They're not up. It's odd.
Yeah, I think the expectation has always been, generally speaking, that the second half of the year would be stronger for the demand from China than the first half of the year. But you're right, Pippa's right. It hasn't been quite as strong yet to start the year. But the forecasts are still, remember last year we had a decline in demand from China for oil. That was the first time in a long, long time that we've seen that. This year expect to see a significant surge. 700,000 barrels a day of demand growth from China is pretty significant. And this oil market is still very tight. There's not a lot of excess capacity. It may be a little oversupplied today, but the second half of the year, if it becomes undersupplied even a little bit, that's going to result in higher prices.
Yeah. So which names or areas do you feel the strongest conviction about right now? And what are they?
Right now, still right now, really like energy infrastructure. Because those stocks rely less on the commodity price and more just on stable, consistent cash flows that happen. So if you take a company like Energy Transfer, it's a 10% dividend yield for investors. If oil prices are 50, 60, 90, their cash flow is still going to be plus or minus probably 5%, the same amount for the year, and they're going to pay out a lot of dividends to shareholders. Same thing with Cheniere Energy. It's the largest LNG shipper in the U.S. Obviously, it's got the LNG trade, and the U.S. being a provider of natural gas to the rest of the world is going to be something we're going to be talking about for decades to come. And Cheniere has got long-term contracts that they're going to be delivering a lot of LNG and a lot of cash flow back to investors for a long period of time, decades more than likely.
All right, these market. I'm sorry. I was just going to say these market pullbacks then perhaps, providing an entry point. And I keep worrying, once everyone reaches peak bearishness, do we get some kind of rebound move? It would certainly complicate the macro here. Rob, for now, we'll leave it there. Thanks so much. We appreciate it.
Thanks, Kelly.
Rob Thummel with Tortoise joining me today.